UK inflation stays stubbornly high. Is a pause from the Bank of England about to become permanent? UK inflation held steady at its highest level in over 18 months this August, piling pressure on the Bank of England just ahead of its key rate decision. Markets are still pricing in one or two more interest rate cuts this year, but with inflation refusing to budge and political risk building, could the path to lower rates be over? Jeremy Stretch is Chief International Strategist at CIBC Capital Markets. So Jeremy, let's start with those inflation numbers. What's keeping prices so persistently high?
Hi, Peter. Well, you are absolutely right. The price pressures are still very evident as far as the UK is concerned. They are uncomfortably high relative to the Bank of England's 2% target threshold. So although we've seen some factors such as airfare prices starting to moderate, there is still and are still concerns regarding factors such as food prices and food price inflation. And that is, of course, particularly impactful for those at the lower end of the income strata. And of course, we're not necessarily at the peak of this inflation profile yet either. That may well come in September or October. So it's understandable that the Bank of England are going to perhaps be somewhat nervous, and the markets are pricing out any prospect of policy easing, certainly for the next two MPC meetings ahead of the budget.
Well, some are forecasting inflation will peak at 6% when we get to December. Is there much more to come?
I think there is worse to come. I think 6% may be a little bit overambitious. I think probably 4% on a headline basis is certainly a realistic number. And indeed, that's the sort of numbers that the Bank of England has in their forecast profile already. And of course, we will get that updated at the November MPR. But I think it's more about inflation and inflation expectations that matter. And of course, also keeping a close eye on the key inflation dynamics, whether it be service price inflation, which did moderate slightly today, but also looking at those underlying earnings numbers, which are also consistent with a gradual deceleration in ex-bonus earnings. So there are plenty of cross currents ahead for the Bank of England to consider. And I think that is going to cause sort of a period of consolidation. So I think after the quarterly pace of policy easing that we've seen over the course of the last year or so, we are going to see probably policy inertia at the next two meetings, yes. But I think the markets are still sort of somewhat wary about the prospect of a December move. And we're currently only pricing in 8 or 9 basis points. So not a significant degree of pricing, but I think there is scope for an increase in that dynamic, particularly in relation to any fiscal tightening in the budget.
Overall, though, HSBC doesn't expect another UK interest rate cut until April. Could you see that as likely?
I think that is, to my mind, and certainly from our view from CIBC, unlikely. I think the Bank of England will be mindful that inflation, yes, remains above target now, but I think they will look at the longer term outlook and keep those expectations very much in focus. I think if we are going to see a degree of fiscal tightening into the budget, and of course the magnitude of that will be somewhat dependent in terms of the OBR judgments, in particular in relation to productivity. But if there is going to be a fiscal tightening in the budget, and or that we see a peak in inflation in that September-October period as anticipated, then I think the bank can look through that above target inflation number now and actually still cut potentially in December. So I think it's highly improbable that the bank will be on hold until late spring next year. Even if they avoid a policy adjustment in December, I think there's still enough justification for them to come back to consider in the first quarter. But I think the balance of risk still favour, to our opinion, a December possible cut from the Bank of England.
Well, policymakers are expected to scale back active gilt sales as well. What would this mean for markets?
Well, we have seen, of course, the bank looking at active selling of government bonds over the course of the last couple of years. There is a smaller redemption profile in the upcoming year ahead compared to last year. So even if the bank maintained a broadly similar level of active selling, that would reduce the total threshold. But if there were to be some discussion about the bank considering moving back to merely passively reducing its balance sheet, so moving away from active gilt selling, that potentially could be constructive for the broader gilt market and potentially constructive for sterling. If we see an APF reduction of around 60 to 65 billion, that will keep active sales at a similar sort of threshold to the current or the last 12 months. That in itself, I think, wouldn't be a particular surprise. Anything above that, I think, could be potentially problematic for both the fixed income space and then ultimately for sterling. So I think it's going to be a case of those active sales and whether they're going to be similar or below last year's threshold as to whether sterling can gain on any traction or otherwise.
So finally, Jeremy, let's talk about the impacts of the government's upcoming budget. What will the Bank of England be looking out for and preparing?
Well, obviously, the bank will be keeping a close eye on any tax adjustments or fiscal changes which could have implications for the inflation profile. It seems evident that the government are trying to raise revenue or considering ways of raising revenue without having a significant inflationary dynamic. So that probably implies that they won't be looking at things like manifesto breaches in terms of changing of VAT. So ultimately, it's the scale of the fiscal contraction that I think is going to be particularly impactful for the bank's thinking and how that will influence their growth models and ultimately the degree of sort of service driven or sort of demand driven inflationary pressure. So I think it's that fiscal contraction, the scale of it, whether there's going to be any implications for the inflation profile, but also keeping a close eye on the demand functions that will come out of that, which could be influential in terms of factors such as service price inflation.
That was Jeremy Stretch from CIBC Capital Markets. Don't forget, you can watch more videos on Reuters.com.